In this edition of On the Radar, we address some key topics that we think should be top of mind to those in finance and accounting regarding derivatives. Now, even though the accounting guidance for derivatives hasn't changed much in recent years, instrument structures and types of arrangements continue to evolve, and we continue to receive a high volume of questions on whether instruments meet the definition of a derivative, how to apply derivative scope exceptions, and when to bifurcate embedded derivatives from hybrid contracts. There also may be some changes coming. The FASB issued a proposed ASU this July that outlines certain derivative scope exceptions, which, if finalized, will impact what requires derivative accounting and what requires bifurcation. But why do we care if something meets the definition of a derivative? Generally speaking, derivatives that are not in designated hedging relationships are recognized as either assets or liabilities on the balance sheet, and they are initially and subsequently measured at fair value, with changes in fair value recognized through current period earnings. Now, what contracts meet this definition? In the simplest terms, a derivative is an instrument whose value depends on or is derived from the value of an underlying variable or variables. Derivatives are net settled contracts that allow the holder to benefit from changes in the value of a referenced asset or other market variable while making a smaller initial net investment than would be required to own that asset and experience similar gains and losses. It's also important to understand that a contract might not meet the definition of a derivative in its entirety, but it can still require derivative accounting if an embedded feature meets all three of the bifurcation criteria. In that case, the embedded feature is separated or bifurcated from the host contract and accounted for as if it were a freestanding derivative. Read all about these concepts and more in the latest edition of our Derivatives Roadmap.